Good afternoon if you're in London, good morning if you're in North America, good evening if you're in Asia, and welcome to the 11th annual M&A Outlook session sponsored by the M&A Research Center at the Business School, formerly known as CAS. I'd also like to thank the panelists for being here and the team who's helped to organize it. A particular shout out to Mark from the events team who's lurking in the background. My name is Scott Moeller. I'm the director and founder of the M&A Research Center at the Business School here, and also a professor in the practice of finance. This is indeed the 11th annual MARC Outlook conference, but it's the first to be held online, obviously, given these very unique situation that we have right now. Usually this is a sellout crowd in the largest auditorium at the Business School, but it's quite nice that we can in fact welcome people from around the world who don't have to travel to London in order to be able to hear what we're going to be talking about today. We do have a very large number of people who have indicated they wanted to attend this because this is going to be recorded. A number have asked whether, in fact, they would be able to watch the recording rather than being on live, just given what the time might be that they were at. And of course, that is going to be available. Our panel, although mainly located here in the UK, also extends to at least one individual who's as far away as the West Coast of the United States, and so quite early for him here as well. Now, our agenda today, after this, what I hope will be a brief introduction, we're going to have a roundtable discussion led by Susan. We'll then have Q&A for the panel from all of you, our participants. We plan to have the event complete at 1:50 p.m. London time, so about 47 minutes. All of you who have registered should have received a brochure about the event that would have been on your chair if you were back in the auditorium. The detailed bios are in the brochure, but just briefly to remind everybody, Susan Kilsby is the moderator of the panel. She is the moderator for the 10th time, and thank you, Susan, for that, both this year and those prior years. Susan is the chair of the advisory board of the M&A Research Center here at the school. We also have Kath Aldisi, who's the head of M&A for EMEA at Credit Suisse. Giovanni Amodio, who's the Chief Research Officer at Accurus Merger Market. Matt Wells, who's Vice President, Global Product Marketing and Strategy for S&C Interlinks. And Lena Seigel, who's the Head of Corporate News at EMEA over at Barron's. This event is governed by what I like to call modified Chatham House rule. It is public information, as you all know, who is participating on the panel. But if anyone quotes or references comments by any individual on the panel or references their organization, you do need to receive permission from them, explicit permission from them, in order to be able to provide that quote or reference. As I did mention, this will be recorded and the roundtable discussion will be available online in about a week, everyone who signed up, as well as being posted on our YouTube channel. Now, if you do have a question that occurs to you either during the panel or during the Q&A, I ask that you do type it into the Q&A area here on Zoom, as that is the only way to post the question. I will be moderating your questions and passing them on to Susan during the official Q&A. If you have a question, as your name will show, can you please let me know as well what your affiliation is with this? So for example, if you're a student, and we do have a lot of students who are attending, please let me know what program you're on. If you're an alumnus, perhaps when you graduate, or otherwise what your company or media affiliation is. Also, of course, you can chat with each other, but I do ask that you do not, during the panel, chat with any of the panelists who hopefully will be focused on what's being discussed in the panel. And it might be very difficult for them, therefore, to be trying to monitor and to respond to you in the chat box. Again, you could pass questions to me in order to be able to ask during the Q&A. So Susan, with that, I think I would like to pass over to you. And again, thank everybody for being here, and also especially the panelists, and over to you, Susan.
Thanks, Scott. And with no further ado, I think we'll launch right into the topic of the panel, since we have only about 45 minutes or so to move forward here. What I'd like to do is turn it over to Giovanni and ask him to set the stage for what happened in 2020, and then we can use that as a launch to talk about what 2021 will look like. Giovanni?
Thank you, Susan, and thank you, Scott. It was a very interesting year last year. So it started really strongly in the first couple of months. Then there was a massive pause between February, March, and the second half, and then a booming second half. So we closed with a 3.2 trillion worth of M&A, which represents a 6% decrease compared to the previous year. But very interesting, so the last quarter had 1.2 trillion, which is the highest quarter ever since the financial crisis, since 2007. In terms of geography, the US represented 42%, Europe 27%, and then Asia 26%. The only winner here is Asia, which increased the share compared to the previous year. The US went from 50% the previous year to 42%. A couple of interesting points geographically. So Europe had an increase in inbound of M&A, so activities from outside Europe into Europe. Then North America had more outbound this year, and Asia had more inbound. So this is quite interesting as well. So with M&A, but there was also a little bit of extra insolvency. So according to our sister publication, Debtware, there was an increase by 30% of the number of insolvencies compared to the previous year. And one final point I'd like to make is SPAC. So there has been a huge increase in the issuance of SPAC. So last year in the US, there were around 255, according to our sister company, Dialogic, compared to 73 the previous year. And the total issuance was 83 billion compared to 15 billion the previous year.
Great, thank you, Giovanni. So there's quite a lot of meat in there, and as Giovanni said, 2020 started out big. There was a big pause in the middle, and then finished big again. So I guess I'd like to turn it over to the panel and ask you about the pandemic effect and about the pandemic effect going forward. Is it good or bad for M&A, and which sectors, which geographies? How do you see the pandemic impacting what's happening from here? Maybe I'll open up. Kyle, would you like to start, or?
Absolutely. Thank you, Susan. So look, undoubtedly the second half performance, as was outlined by Giovanni, was very, very strong. So to answer your question simply, I think there's obviously been an impact of the pandemic, but it hasn't slowed deal making activity. I think one of the reasons for this, and there are many, but just to touch on a couple. Number one, I think the pandemic has accelerated a number of trends that we'd already seen in the broader economic environment. Digitalization, for one, for example, and also I think it challenged a number of business models of a number of corporates. So as a consequence of that, Susan, you've seen the equity markets differentiate more strongly than ever between call them winners and losers as a result of the pandemic. As a consequence of that, I think the strategic questions that boards have been faced as a consequence have also accelerated. And the M&A is an important part toolkit when boards and their management teams need to consider these strategic questions that are being put to them in an accelerating manner. And what I would say is those corporates that have done well are asking themselves, how do they capitalize on the strength of their business models and indeed the strength of their share prices and valuations to further extend the lead. And while those who have done less well need to consider whether they actually need to delever, sell a business, indeed look for a catalyst in their share price, which may involve the sale of the company or indeed the sale of a division, or consolidate within their own division or within their own industry to be more relevant. So I think a number of questions still remain outstanding, but the impact of the pandemic, I think, has asked bigger and often accelerating questions of boards, and M&A remains a very important part of the toolkit in answering those questions. So we remain optimistic for the outlook for M&A, notwithstanding the pandemic.
You talked about winners and losers, and you weren't specific about terribly specific about any sectors or geographies. So I'm interested. Is it across the piece, or because there are winners and losers in each sector? Or I'd be interested from the panel broadly. Is it are there industries, or is it just each industry has people who win and people who lose, and it's really very widespread, this the impact? Views? Lena?
Yeah, I can try and answer that. Thanks, Susan. So I think it's really interesting because obviously the software and telecom has rocketed the use of consumer use of it and business use during the pandemic. So we've seen quite a few software deals, and we've seen telecom deals taking place as well. And then it's interesting in the consumer and financial divisions, back to Kathel's point, which is that we had these sectors were under scrutiny already, and were having to look at what they were going to do, whether they were going to merge or sell non-core divisions, as we're seeing a lot of the consumer companies do. So those plans were sort of like hovering around before the pandemic, but the pandemic has accelerated that. So we saw in the last quarter and in the last quarter a lot more financial services in Europe, where we know there's been a big issue with falling profits for a long time. And so the pandemic has helped sort of accelerate these, but I think tech and TMT will continue to be quite strong. Yeah.
If I can add, one important thing in M&A is the data. So just think about what Scott said earlier. So this event is for the first time virtual, so we can't do it physically. But imagine how many more people are able to participate. And you, as an organizer who organizes events, you have seen in 2020 the business of events collapsing. But at the same time, if you were able to adapt yourself, you are able to get a much larger base of people attending those virtual events. So what can you do with this data? You can profile people, you can then give them something different, you can sell stuff. That's one element. And the second element in terms of sector, yes, telecom was the largest sector in North America, but then in Asia, for example, was energy. Again, so it's not just about energy, but it's about the data that you can get from the consumer or the customer of the energy companies.
I'd be interested in your perspective, because from where you sit, you actually have a lot of early warnings on where the activity is happening. What do you see, what is the pandemic effect from your position?
Yeah, that's correct. We do have a bit of a unique perspective, given that, we sort of see deals, in the pre-announcement stage. So let's say 3 to 6 months before announcement, leveraging our platform. So we have insight into sort of what the next quarter or two of activity, at least in terms of deal volume, will look like. So, obviously last year there was dramatic peaks and valleys. And so far, this year, based on what we're seeing in terms of early stage deal activity, it seems to continue sort of the frothiness or high activity levels of the last quarters, Q3 and especially Q4. According to our deal flow predictor, which is a piece that we publish quarterly, we are predicting M&A for Q1 globally to be up 18% in terms of deal volume. That's the midpoint. Sectors leading the way, echoing what most of the other panelists have said so far. We're seeing financial services, healthcare, energy, industrials, technology in terms of the most activity, with restructuring activity around oil and gas, continued restructuring activity around retail and commercial real estate.
Great, thanks. Okay, why don't we move on? One of the things that was referenced by Giovanni earlier were SPACs, the special purpose acquisition companies that we're seeing quite a lot of in the US in particular. And I guess I just put out the question, is that good or bad for M&A and activity? And And which buyers and sellers will it impact? I open it up to anybody who'd like to start.
Look, I'll give it a go, Susan, given that maybe a bit of advertising and credit is number one in this space. Our colleagues in the US have a fantastic franchise in this space. So you're correct. We saw a real, the word explosion is used incorrectly on many occasions in these types of forums, but as it relates to SPACs, I think it's absolutely the case. We saw a 6-fold increase in SPAC IPOs. So that's when the vehicle itself, the acquisition vehicle, is put in place and the capital is raised. And then we saw a 5 times increase in terms of the capital raised associated with the de-SPACing event. So when that SPAC entity merges with, with a private company to go public. So we very much feel that, the efficiency of the SPAC process is something that is very attractive to sellers. The speed at which they can go to market is accelerated. And often the sponsor of the SPAC, adds something to the target company, whether it be credibility, industrial knowledge, track record, and even in some cases, a degree of synergy or know-how around that is additive to the standalone equity story. So I think, undoubtedly, when you've got such an acceleration with any new product or new evolution, there'll be elements that are very good and there'll be elements maybe that are less good, and that'll wash out over time. But the characteristics of the SPAC market are positive from our perspective, and offer, like I said, sellers, and often in often cases these sellers are financially literate, so financial sponsors, and they're still using this avenue to monetize their interest in some of the portfolio companies and go public at the same time. So the rate of growth will have to slow by definition, but we think the product is here to stay and is a useful addition to the M&A market when people to monetize assets. And when we think about routes to monetize assets, we're more often than not now talking about triple track rather than dual track, looking at M&A, IPO, and SPAC.
And if I can add one point here, last year we only had less than 10 SPAC that were not able to use the funds that they received. So just for the audience, a SPAC has 2 years to find the target. So the big test will be towards the end of next year or mid next year, when all the SPACs that were raised last year will come to an end, and then we'll see the real status of the market.
I think it'll be interesting to see what happens with SPAC activity in Europe, because obviously it's all been in the US, but you've seen quite a few Europe-focused SPACs, but they're still choosing to list in the US. And then one big one that was trying to get off the ground last year, which ended up having in Europe, listing in Europe had to be withdrawn because of a lack of investor interest. So it's not clear yet whether they'll be able to get off the ground here.
Yeah, Lena, I think you make a very good point there. Clearly, this is a US phenomenon, and we've seen European assets merging with US SPACs. I think the feedback we've had from European investors is they would like to have access to SPAC investment opportunities in Europe. We're clearly working that through, the listing location, the regulatory environment, and then obviously the scale are still aspects that are not easily replicated relative to the US, but we believe there's a path forward, and we expect to see more European SPAC activity, albeit from a much smaller base than the US, which is clearly ran ahead of us in significant sense already.
One last SPAC comment from my end, and I thought that the triple track comment was absolutely accurate. We're seeing the same thing on our platform in terms of activity. And I think it's just interesting because it's another option on the table. And while I haven't done the research or confirm this, you would think that that would have an impact on valuations because it's one more choice for sellers. And given, I'm sure we'll get into the amount of dry powder and capital that's readily available out there. I think just having that option in addition to IPO M&A for the right companies, especially in sectors that we've already spoken about, could definitely drive valuations back up.
Great, thank you. Why don't we change topics and talk about an old favorite, the activists? In the current environment, is activism dead? Is it alive? Is it dormant and will come back to life? What are your views here, and how does it impact activity over the next year? Lena, you want to?
Yeah, sure. So we saw at the very beginning of the pandemic that activists kind of took a back seat, and actually when I spoke to a whole bunch of them early on in sort of May, etc., June, they were saying that now is not the right time. They wouldn't get an audience basically from the boards. So they gave them some breathing space, but then they came back pretty quickly, and they I think the UK companies at the moment are. I think there was a recent study that showed that they were they're set to be the most targeted companies. They're all so many are trading at a discount to their global peers and need shaking up. And obviously the regulatory environment is much easier than some of continental Europe in order to be able to get an audience and the appetite of institutional investors. But I think that given that institutional investors are much more willing to side with activists, means that the activity will continue this year, and M&A seems to be the biggest driver, obviously, of shareholder returns for them. So it's a quicker hit than changing the CEO. And so I think it'll continue to be quite a big part of their strategies.
Thanks. So they're here to stay. The small breather they gave to the boards, in your view, is just a small breather.
It was a very small breather. Yeah, they came back pretty quickly. Yes, and you're seeing the Americans also coming. Looking at the UK companies in particular, which is interesting.
Absolutely. Let's talk about protectionism, and we've seen more and more where governments have tended to become more circumspect. And there is much more protectionism out there these days. How do you think that'll impact? How's that going to play out? How's that going to impact activity? Go ahead, Lena. I know you want to talk.
Well, I just think what's happened with protectionism really is quite fascinating, because there's been a steady drumbeat in continental Europe over the last 2-3 years when the Chinese were coming in for German robotics companies. But then it sort of fell by the wayside. But in the last few months, they've really pulled up actors now. The UK overhauled its takeover regime in November, and it was the biggest sort of overhaul in 2 decades. And ministers can now look at deals retrospectively, five years, I think it is, which is, and the language when the government put out the announcement was quite hostile. It was basically, we're shutting out foreign bidders. Well, we have the powers to shut out foreign bidders. So everything, I think, and you've seen the same in Italy, France. You saw just last week that the Canadians tried to buy Carrefour and quickly withdrew because of the French finance minister's comments. Well, it's possibly you should try and talk to these governments. I mean, you don't try to buy France's largest private sector employer without sort of clearing the ground first. But at the same, so I think there'll be, I do think that protectionism is going to get tougher and tougher this year, and will come under a lot more scrutiny, and it will be up to companies to pave the way ahead, because they always get the same reaction.
So interestingly, so you're saying there's an attitude of protectionism, but you think there are ways for companies to manage around it, that it's a soft protectionism, is that, and that if it were handled correctly, there would be more M&A activity, or what how do you see it? Or am I misinterpreting?
No, you're totally correct, and as you've seen, a lot of it is rhetoric as well, and it is politicians' rhetoric. I mean, nobody will ever forget when, you know, yogurt was deemed a strategic asset all those years ago by the French. But so it will sort of be industry by industry, but if they can forward some of the remedies, you know, where they agree to keep the headquarters in the country, the target country, and agree to keep that number of employees, they seem to be able to get around it, some of these bids. So, but they're making it tougher. The governments are making it tougher in this country, at least, to make sure that those are binding requirements from the companies.
Thanks. Carla, did you want to say something? Sorry.
Yeah, no, absolutely. So I'd agree with Lena's comments. I think, look, in Europe, well, I suppose take a step back. I think if we look at last year and look at the G20, we did see you know, a record in terms of interventions from governments around M&A. So I think your instinct is right, Susan. There's more intervention here. So that's point number one. And clearly the EU and the UK individually are stepping up on infrastructure, let's call it, around the assessment of inbound M&A activity and how they assess that. I still feel, however, that you know when we think about big ticket M&A for us, you know, it's dominated by the cross-border activity within Europe or across the Atlantic, right? And generally, I think, you know, boards would take the view that that's manageable from that perspective. Clearly, as Lena pointed out, France is an area where you need to prepare well. But I do think that France is probably towards the more sensitive, you know, jurisdictions. Not to say you can't do deals in France. There's been many deals done in France, but you need to manage it appropriately. And notwithstanding the fact that we're seeing new regulation coming in, I do believe it's, you know, something that corporates believe is that they're able to navigate, as Lena mentioned, with proper advice. And you need to differentiate between the politicians playing maybe to the electorate and the substance of what they're trying to achieve, while also trying to, you know, encourage inward investment into their country. So it's relevant, you need to manage it, but I would be cautious to suggest that it would have a material impact in deal activity.
And you can add, I'd like to just give one figure. So yes, protectionism will always be there, but last year we had 111 mega deals above $5 billion, which is 20 more than the previous year, and that's the second time highest in the history of M&A. So for one deal that gets blocked, there are tens that don't get blocked and are as big as those.
Thanks. So, you know, we're living at a time with historically very high stock markets. And I guess I'd be interested in your perspectives about, one, how this impacts M&A activity, and not just the activity, but also the nature of the transactions, how they're structured. I suppose if you're a buyer and you can use your high currency or high stock price as a currency, it can be positive, but there are then risks for sellers. So I just wonder how you look at that and how you see the current stock market affecting values, deal structure, and activity. Carlo.
Yeah, thank you, Susan. So look, I think it's always worthwhile taking a step back, and while it's you know, maybe not you know, a good fact, but the reality is that there's a very high correlation between high equity markets and M&A volume. So M&A is generally highly correlated. M&A activity is highly correlated with a strong equity market environment. So, but I think, look, undoubtedly, I think, a number of people do look at the current equity markets. They look at, paying a premium, particularly in sectors that have done well. So as mentioned by others, call it tech or healthcare, and you need to pay a premium on top of that. So we spend a lot of time with clients just thinking about what the discount rate is, what the risk-free rate in the future is. Many people on the phone, particularly students, I'm sure, are giving thought to that. But to your point, I think what we're also seeing is, and we saw this last year, is that the relative value transactions, so people using their own stock to make an acquisition, increased. It was a larger component. So that was 20% of all, 25% of all deal activity last year was deals involving a stock component or an all stock component. I think actually there's a couple of reasons for that, Susan. So number one is the relative value discussion. So if I'm using my own stock, I have to just think about relative value rather than absolute value. I think the other aspect of it is clearly we talked about winners and losers. There's many lenses you can look at that. You can look at by industry, within industry, but another one is scale. So larger companies did better as well. So I think, if you do an all-stock deal, you're increasing your equity base rather than putting debt on the company, right? You've got a more liquid stock, you may be in more indices, and so on and so forth. So I think in this environment, it encourages the use of stock consideration. Historically, that's been a challenge cross-border because you may have local markets, local investor bases. But the capital markets continue to be more global. Many of the fund managers run global funds rather than regional or country-specific funds, which also manages that. So I think the high equity market helps M&A, and where you've got issues around absolute value and people being cautious around that, I think we'll see more people using stock consideration as part of the mix.
Thanks. Okay, I'm gonna hand over to Scott in a few moments for questions, but I thought I would just turn it over to the panel and ask each of you, how do you see 2021 compared to 2020? Will activity be higher, about the same, or lower? Maybe I'll start in my screen. Giovanni, you're up at the top left corner. I'm starting with you on use.
I think it's going to be the same level of this year. Two factors. One was mentioned earlier by Lina. So in the UK, especially, there are low valuation. So there's going to be quite a bit of opportunities for take private. And the second one, we registered quite a bit of a decrease in M&A activity so below 250 million. So all these companies that haven't done anything last year, they will have to be doing something this year. So they will either be bought by larger companies or they will have to be merging with each other.
Matt?
I think we'll see a continuation largely of what we've seen in the second half of the year. I think we're still pulling through deals that may have been delayed in Q2, which will have an impact on Q1. I think if you look at year over year, levels may be more or less around the same. Shouldn't be as choppy as it was in 2020. But I think with positive news around, vaccines, countries probably opening up a bit, APAC probably leading the way in terms of volume year over year. Definitely predicting, some a return to normalcy, whatever that may be, and at least growth over last year.
Thanks. Carl?
Well, we touched on this earlier. I don't think you'd expect an investment banker to say anything, but have a positive outlook on the M&A market. I'm not going to disappoint you on that front. But let me try to be a little bit analytical. So as people have mentioned here, the second half was extremely strong. So, and the fourth quarter was stronger than the third quarter. So there's an acceleration of volume here. I do take the point. There's probably a little bit of pent-up demand coming through from the stuff that we had in Q2, but nonetheless, we see that momentum coming through and continuing. Mentioned earlier that corporates need to look at M&A in a more challenged GDP growth environment, even though we'll have a bounce from, you know, post-COVID. Nonetheless, overall economic activity is, you know, still rather benign. So M&A is important. Within cross-border activity will be an important part of the toolkit, as we talked about with the UK, but all of Europe trading at a discount to their US peers in particular. And then I think in Europe, corporates need to look at corporate carve-outs. So they'll rotate capital either to refine their portfolio, deleverage. There's many motivations for that. And if they don't have a motivation, an activist bring the motivation. So I think you put all that together, and, you know, an improving CEO and board level confidence. You know, I'm optimistic on the outlook for this year, and I expect us to be up in terms of volumes relative to 2020.
Thank you for not disappointing. There we go. And Lena, I'll turn it over to you for the last word before I open it up to questions through Scott.
Thanks. Well, I mean, as the journalist on the panel rather than the practitioner, I am always careful about the pipeline being full, but it looked pretty good at the moment. However, I do think that as the year carries on, investors are going to scrutinize deals a lot more. We're already seeing a couple of big ticket ones where they weren't greeted in quite probably the same way as the bidder would have liked them to have been. So skepticism will start to increase as the pipeline flows.
Great, thanks. Scott.
Well, Susan, as you can probably expect, we've had a number of good questions coming in, not just in the Q&A chat here, but I've had a couple that have been emailed to me as well. So thanks to you know, to people who have sent those over here to me. There have been two questions that came in regarding China, you know, and we haven't really talked explicitly about China. One of them actually did point out that China outbound healthcare renewables actually doubled, you know, in 2020. You know, so there are some areas, and that's outbound. So, you know, their activities outside of China. What's the panel think, or pass it over to you, and to you know, to steer that question about, you know, what they do think about China, one of the elephants in the room.
And Lena, I see you've muted. You're
Well,
ready to go.
It sort of combines all the subjects we've just talked about, because protectionism will mean that Chinese outbound is going to be tougher. But at the same time, it's how do you balance the need for capital that some of these countries need? So so I think that but the rhetoric against China has ramped up, obviously, everywhere. So I think that's definitely going to be a tough sell coming in to Europe. And then but then as well, the fact that all these companies are going to have to look at their changing supply lines because of what's happening means that that could also drive M&A. So that's my 2 cents worth on it.
Any other views from the panel?
Yeah, you know, I think Lena's right to focus on the protectionist element when it comes to China, clearly. But look, we've seen some activity out of China at the back end of last year in the resources space. But I do think it's important to put that over, you know, put the China volume in, you know, in context of the overall global volume, or even in Europe. Europe is very much at the crossroads of M&A, so we see more cross-border volumes than anybody else. It was about 4% of volumes last year. And I'm just looking at some statistics here, like inbound activity, you know, in total last year was about 227 billion, of which 187 billion came from the Americas, with 41 billion coming from Asia Pac. You know, it's a topic that, you know, that gets a lot of mind share, but actually when you look at the data, is a much smaller number. There's kind of a disconnect between the mind share, I would say, Susan, and maybe what the data would suggest.
Thanks. Scott?
Susan, another area of questions, and it's actually been a theme of a couple or a few questions I have, is back to the private equity point, and Matt mentioned, the dry powder that's out there, or I think you even said maybe we'll be talking about it. Well, I guess this is the way to talk about it. But there was one question about whether, in fact, there was any thought that some of this dry powder might be put into some of the MBOs that are, that are continually being proposed. But the other, to answer the question of when will this dry powder eventually be used, because I think if I go back over the last several M&A outlook sessions that we've had together, Susan, every year we seem to talk about the large amount of dry powder, that private equity firms have. So just seeing that question over to you.
Matt?
I will start with some data. So according to our statistics, funds have 1.7 trillion dry powder as of last year, which is quite impressive. And last year only, technology was the most active sector for protective firm. So we're going to see, hopefully in the next year or two, this dry powder be utilized. There are more funds being raised in the technology sector, or more private equity firms acquiring companies in the technology sector, or with some data component. The only issue with private equity is that the exit activity last year wasn't as good as the previous year because of the market uncertainty. So all the assets acquired in the previous year will still be held by these private equity firms. So these are the two main factors.
Yeah, Scott, to your point, I feel like I've been on several of these types of panels over the last few years where I've used the phrase, cash on corporates' balance sheets and dry powder, in private equity coffers, and that has not changed. The 1.7 billion number, obviously that's a huge one. How are they going to spend it? I do think you are seeing some of the larger private equity firms step up to the level that you wouldn't think that they could compete at before with strategics. And being able to pay, what a strategic can based on synergies. Not to say that they're undisciplined, but knowing that in order to win some of these deals, they're going to have to, spend some of that powder. So I think a lot of it, will start to get used up in those types of deals. Maybe even seeing some of those larger mega deals go, the way of private equity. But that said, I wouldn't be shocked if we're sitting here next year having the same conversation and we're dropping the private equity dry powder, and it's still near that 1.7 trillion mark.
Susan, just maybe that. Look, I think the undeniable fact is that the asset class is growing, right? So Scott, I think by virtue of the fact that the asset class is growing and more investors are putting no money into the private equity asset class, but on the equity side, but also the private credit side, will mean that this dry powder continues to grow, right? Because it's a growing asset class, and I think their propensity to do larger deals has grown over the years, so they can deploy it. And as we touched on earlier, we're seeing them doing very large corporate carve-outs. 50% of the corporate carve-outs last year, activity in Europe last year, was bought by sponsors, and clearly they're far more active in the public markets with large public to privates.
Thanks.
Susan, there was another series of questions. I don't mean one right answer the other, but which related to, I guess, the risks that we have now in doing M&A deals, and will that come back to haunt us, where in fact people don't see each other face to face, and due diligence, which is so critical to success, is being done in a very different way. And perhaps it relates to a similar question I'm getting that probably would relate directly, Matt, to another thing that, of course, is what SS&C Links, is doing about that whole rise of how that due diligence is now being done, electronically. So, but the question, if I try to squeeze a couple together, because we really do have many more questions that have come in that we'll have time to be able to answer here, is around this softer side, of the business being impacted, and the role, of technology in mitigating that risk.
Yeah, I guess those of you who spend a lot of time in this part of the deal process, I'd be interested in hearing how you see that risk and how you see the world changing? Will we be going back to all face-to-face due diligence, or are we virtual now?
I can speak to what we're seeing briefly. I think there certainly was, rapid agility and in terms of technology adoption across the board when it comes to due diligence. Obviously, driving, the ability to get deals done at the volume that they were in Q3 and Q4. We can see that directly reflected by the amount of video content, for instance, that's uploaded to uploaded to our data rooms. That said, we're in constant communication with advisors, corporates, private equity firms, and while there's certainly more management meetings conducted over Zoom, there is almost always some sort of face-to-face meeting before a deal has been closed, and whether they wait. There's that final bidder, and then they do that in a socially distanced fashion. It hasn't completely eliminated the human element, which is obviously extremely important in the M&A process. But I do see or foresee over the next coming years, people getting more comfortable with leveraging technology as part of that due diligence process, and definitely altering it for the long term.
Thanks. Scott, I think we have time for probably one more question if you.
Yeah, okay. I'm going to take moderator's prerogative here and ask a question, but it is actually similar to one that somebody has actually posted here. Good time or a bad time for all the students who may be on here to get into M&A, and any advice for them? Because we certainly do have a very large number of people at the business school who would love someday to be sitting in the chairs that the panelists are sitting right now. So any advice for them is kind of a closing thought, Susan?
Who would like to respond? Help out the panelists. Is it a good time? Are you hiring? Is it a not so great time? And if they're interested, how do they go about finding their way in this world?
I'll chime in quickly. I think
oh, Matt, there you go.
It's always a good time, because from my perspective, there are many ways to quote unquote get into M&A. I started my career in M&A, traditional investment bank, M&A advisory analyst, and spent 5+ years doing that. But there are also startups focused on the M&A world. There are technology companies such as SSZ Intralinks, which are focused on the M&A world. So I think there are broad ranges of how you can enter the industry. And it's just as exciting as it was my first day in a traditional investment banking analyst role. So I would think that there are even more options today to quote unquote get into M&A.
Susan, maybe I can give you perspective maybe from someone who's kind of joined as an analyst and grown up through the investment banking world to my current position. I think I'd encourage anybody to consider the industry. I think it's very dynamic. I think it'll stretch people both intellectually and personally. And I think you put yourself in an industry where you're trying to assist corporates who are ultimately run by individuals make good decisions about how to deliver value for their shareholders and broader stakeholders at critical times in their career. And that is, as Matt said, a very exciting dynamic that you're getting exposed to. So, and I think, look, I can say this maybe as a person on the who's working for a bank. The financial industry, post-financial crisis had to kind of reflect on itself. I think a few people may have asked as to whether the financial industry is the right place, to work. But we've worked very hard in thinking about how we, support society at large and the cultures that we have within our organizations. I think as a leader of within the Credit Suisse team, I feel very proud about what we've done there, and think we can offer people a good professional an exciting career, but also very much one that's consistent with what society and what we want to do socially and culturally.
Thanks. And I want to say thanks to all the panel for your contribution. I think we'll try and stay on time here. I'll turn it over to Scott for final words. But again, I hope everybody who's on the call has found it informative.
Susan, certainly great. And as I say, there were so many questions that I could have asked as well. And I apologize to anybody whose question didn't get answered. But if you happen to have been a student, then just take my class. We'll try to do the in that one. I do want to thank you, Susan, and again to Giovanni, Cathal, Matt, and Lena. That's the order that they happen to appear on my screen here. For this, I would like to remind everybody that we will have a recording of the panel session that will be available at some point in time. We will email a link to you, I think, as a follow-up. But if that's not going to be happening, or you don't receive that, it should be available on our website for the business school. I remind everybody too about the revised or the modified Chatham House rule, and that is that if you do want to quote on social media or anywhere else, the comments made by any of the individuals or their organizations having made that comment, then you do need to get permission, from the individual or the organization in order to be able to do so. Can I also, just as a parting comment, remind anybody who's interested in this topic of M&A that you may want to contact us about our other major annual event, which is an academic conference that takes place each year in summer, this year in June, that attracts the leading academics from around the world who present over the course of a day their recent research. So another hopefully very insightful session that will be taking place then, albeit that is an all day long academic conference. And with that, again, thank you to Susan, Giovanni, Cathal, Matt, Lena, and all of the people who have attended. And this marks the end of the event. Thank you very much.